Hello and welcome to Calmvestor Podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Have you ever wondered how some of the world's greatest fortunes were built? Surprisingly, many were forged in the darkest times of market crisis. It sounds counterintuitive, does it not? Think about the chaos of market downturns, like 2008, or the early days of the COVID-19 pandemic. The overwhelming sentiment is often panic, leading many to sell off assets indiscriminately. It is a natural human reaction to fear uncertainty. But amidst this turmoil, figures like Warren Buffett stand out. He is often seen as a contrarian, someone who sees opportunity where others primarily see risk. He famously advised to be fearful when others are greedy, and greedy when others are fearful. How does Buffett maintain such composure and even buy when markets are collapsing? What is the secret to his approach during times of crisis? We will explore that today. So what exactly is crisis investing in the Buffett style? It is not about blindly trying to catch a falling knife, hoping to time the market perfectly. That is speculation, not investment. Instead, it is about identifying and acquiring wonderful companies at reasonable or even bargain prices. This happens when the broader market is pessimistic and misprices these excellent assets. Buffett looks for value that others overlook in their panic. Buffett's core philosophy is that you are buying a piece of a business, not just a stock ticker that goes up and down. He views stock purchases as acquiring small shares in an entire business operation. This mindset changes everything. Patience and a long-term vision are crucial. Buffett does not try to predict the exact bottom of the market. As his mentor Benjamin Graham said, "Price is what you pay. Value is what you get." The focus is on the underlying value, not fleeting price movements. A classic example is Buffett's investment in American Express in the 1960s. After a scandal involving salad oil, the stock plummeted. But Buffett saw that the core business, its travel and card services, remained fundamentally strong. He invested, and it paid off handsomely over time. Why do so many individual investors struggle during crises? The main challenge is often psychological. Fear and the herd mentality can lead to panic selling, locking in losses. Many also lack the knowledge or framework to assess a company's true worth amidst the chaos. It is hard to see the forest for the trees when news headlines are screaming disaster. Another common pitfall is trying to perfectly time the market by catching the absolute bottom or predicting short-term swings. This is incredibly difficult, if not impossible, even for professionals. It often leads to missed opportunities. The constant barrage of negative media during a crisis can amplify fear and cloud judgment. Furthermore, many investors are simply unprepared, lacking available cash or a watch list of potential companies to buy when prices are low. Think about the COVID-19 downturn. Many investors sold good stocks in the initial panic and were too scared to get back in, missing the strong recovery that followed. As Jim Rohn said, if you do not have a plan for yourself, you will likely fall into someone else's plan. And guess what they have planned for you? Not much. What are the root causes of these mistakes? Often it is a misunderstanding of value investing principles. There is a focus on short-term price fluctuations rather than the long-term intrinsic value of a business. Many investors do not fully grasp the concept of margin of safety, a cornerstone of Buffett's approach. This means buying a company for significantly less than its estimated intrinsic worth, providing a cushion against errors in judgment or further market declines. Instead of deep business analysis, looking at the business model, competitive advantages, and management, the focus shifts to price charts and market news. This is often driven by a desire for quick riches, rather than patient wealth building. Market downturn is often equated with the permanent decline of good businesses. But history shows that strong companies endure and recover. Buffett himself has said, "Risk comes from not knowing what you are doing." Indeed, Buffett also stated, if you are too fearful when you see stocks drop by 50%, you should not be in the stock market. This highlights the importance of emotional control and the long-term perspective. So how can we apply Buffett's principles to turn crisis into opportunity? It starts with preparation, even before a crisis hits. You need to be ready to go hunting when bargains appear. This means building a watch list of excellent companies you would love to own. Research them thoroughly. Understand their economic moats or sustainable competitive advantages. Evaluate their leadership and financial health. Determine an estimated intrinsic value for these companies. This is your benchmark for what you believe the company is truly worth, independent of its current stock price. It is about understanding the business, not just its stock. Crucially, have cash ready. Buffett always maintains significant cash reserves. This allows him to act when opportunities arise without being forced to sell other holdings. As he says, opportunities do not come often. When gold rains from the sky, reach for a bucket, not a thimble. Buffett is known to meticulously research companies he admires and then patiently waits for the chance to buy them at an attractive price. This preparation is key to acting decisively when the time comes. When the market panics and prices fall, it is time for decisive action. This is when you apply Buffett's mantra: be greedy when others are fearful. Market crises can offer unbelievable prices for outstanding companies. The key is to buy when there is a significant margin of safety. This means the market price is well below your estimated intrinsic value. Bad news can actually be an investor's best friend if it creates these price discrepancies for strong businesses. Focus on the fundamentals of the business, not market sentiment. And importantly, buy what you understand. Buffett famously avoided many tech companies during the dot-com bubble because he did not fully grasp their business models at the time. Do not try to catch the absolute bottom. Nobody can do that consistently. Instead, consider buying in stages as prices become more attractive. As Buffett emphasizes, having a clear investment philosophy and sticking to it is vital. Consider Buffett's investment in Goldman Sachs in 2008. While the financial world was in turmoil and Goldman stock was plummeting, he invested $5 billion. He secured preferred stock with a 10% annual dividend, showcasing a shrewd way to capitalize on crisis while managing risk. Similarly, his investments in companies like the Washington Post or Wells Fargo during difficult market periods for them also demonstrate this principle of buying quality when it is temporarily out of favor. Once you have acquired these great businesses at good prices, the next principle is patience and a long-term holding mindset. Buffett often says, "Our favorite holding period is forever." View your stock purchases as buying a part of the business. If the company remains fundamentally strong, let the power of compounding work its magic over many years. Do not sell just because the price has gone up or down in the short term. Buffett suggests selling only if the fundamental business deteriorates significantly or if you find a much better opportunity. He has noted that doing nothing is often the wisest course of action for long-term investors. Periodically reassess your holdings, but do not get swayed by the market's daily noise. As Buffett famously put it, the stock market is designed to transfer money from the active to the patient. His multi-decade holding of Coca-Cola is a testament to this. Despite market fluctuations, his belief in the brand's strength and long-term growth potential remained unwavering, and it has rewarded Berkshire Hathaway immensely. In conclusion, market crises are an inevitable part of investing. They can be scary, but they are not necessarily the end of the world for your portfolio. In fact, with the right mindset and strategy inspired by Warren Buffett, they can be significant opportunities. The key lessons from Buffett are to focus on quality businesses, buy them when they are undervalued due to widespread fear, and hold them for the long term. This requires discipline, patience, and a commitment to continuous learning. I encourage you to start building your own knowledge base. Learn about companies you admire, understand what makes a business truly great, and begin to prepare your own financial plan for when market sentiment inevitably turns sour. Remember, investing is a marathon, not a sprint. As Buffett has observed, in the long run, the stock market news will be good. With a sound strategy, you can navigate the storms and build lasting financial well-being. As Anthony Robbins said, it is in your moments of decision that your destiny is shaped. Choosing to learn and apply these principles could indeed shape a more secure financial future for you. Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.